All right. It says the meeting is preparing to live stream. This is the Investing Power Hour on Chit Chat Money, number 67. And it's a special one today because we actually have three guests. Two have been on the show before. One, we need to get on the show to do an interview on a financial stock sometime soon. It is Jason Hall, Travis Hoyam, and Matt Frankel. Guys, welcome to the show.
Thanks. This is awesome. Glad to be back on.
Yeah,
All right.
great.
Yeah. And guys, you're on for a special, I guess, event, an announcement. What is this announcement and what do you guys have going on in Alexandria, Virginia on August 18th?
You guys want me to go first? Yeah, I'll go first here. So it's interesting. This is something a lot of us have talked about. Travis, you and I've talked about doing something like this before, I think the most. But the idea is to create opportunities for regular investors. Because like all of us, every single one of us on this, at some point, we were just a guy that was trying to figure out how to buy stocks, a guy that was trying to figure out how to manage money, how to make the right decisions, all of that kind of thing. And doing the podcast, the smattering I do with Jeff, he is still like the regular guy. He has a full-time job working for a school district. And this is the thing that he does on the side. There are so many people like that they don't have access like all of we do. We can DM each other on Twitter. Half of us have each other's phone numbers. We can talk. And there just aren't a lot of opportunities to really engage, not just with us, right? The experts and the people in the know, but also just to engage with other people that maybe you have proximity to that you just don't have in your regular life. So what we've decided to do, there's a group of us that are going to be in Alexandria, Virginia on August 18th. It's a Friday. I got the date right, guys? Yeah, August 18th. And from 2 to 6, we have reserved a private spot at, oh goodness, and now the name's falling out of my head here. Lost Boy Cider, which is in Alexandria, Virginia. It's easy to find. And we're calling it Money Collaborative 2023. If you go to moneycollaborative.com, thank you, Travis Hoyam, for putting the site together. You can reserve. Now, here's the thing. We have room for about 50 people at this event. And you have to have places to do this. And nothing's free anymore. Nothing is cheap. So it's $100 a person. But what do you get for $100? You're going to get Travis talking about asymmetric investing and his process to find asymmetric opportunities. He'll talk more about that today. You're going to get Matt Frankel, who is an absolute expert in financials, real estate. He is a value investor. He owns real estate himself. He is a chartered financial planner. He is a CFP. He is a real money expert. You're going to get me and Jeff Santoro. We're going to record an episode of the Smattering live in person. And I'm guessing a few people that are watching this have probably heard our show. So we're going to get to do it live. We're going to have Tyler Crow, who does a lot of the YouTube videos with me. It's going to be a lot of fun. We're going to have Lou Whiteman, who does his Fits and Starts blog, which is a great resource for people how to think about investing and how to manage themselves. So you're going to get proximity to all of us. We're going to share some of our best ideas. We're going to do a lot of interaction. We're going to have food. It's Lost Boy Cider, so there's going to be plenty of cider flowing, and we're really, really excited about it. Travis?
Yeah, I think this is really an opportunity for us to have the kind of discussions that we have on a semi-regular basis with a larger group of people, get feedback, and sort of get a little bit more meta. The content that we create on a daily basis, whether it's an article, even I did a spotlight of a stock yesterday. That was 2,500 words. I'm still just scratching the surface of what I think about that business, the process that goes into finding those kinds of investments, how I think about the strategy of any given business or industry. So we can have longer form discussions that are maybe a little bit more high level that don't necessarily make sense for a specific article or video. And I think that's what's really, really fun and interesting. I did one of these almost a decade ago now, and it was just fascinating. The things that people wanted to pick my brain about, and I'm not necessarily going to know what those things are until we get there. And that's part of the fun of it, because a lot of times these discussions are very one-sided. We're creating content, people are consuming content, but unless you send me a DM or a comment in YouTube or something like that, I don't necessarily know what you're taking out of anything that I'm producing. So this is kind of a way for us to get some feedback. So I think that's what I'm really looking forward to, is having a little bit more of a personal connection with everybody that joins us.
I want to loop Matt in here as well. I think listeners are probably familiar with Travis, familiar with Jason. This is a good chance to plug that Travis's pitch on GM is up 30% since he came on the show. And then Jason's been on a couple times, but I guess Matt,
We will never hear the end of that from Travis. I just want to say,
Hey, if it becomes an asymmetric stock, I'll just come on once a week and toot my own horn.
I guess listeners might not know as much about you, Matt. Can you maybe provide some background? Kind of how did you get into the field of investing? What do you do today? What's kind of your investing ethos, I guess?
Yeah, my internet connection hasn't been great today, so sorry if I fall out at all.
It's been good, so no worries.
Can you hear us, Matt?
Maybe not. I jinxed it.
Brett, you broke his audio.
I know. I definitely jinxed it. Yeah, I can't hear you.
No
Matt.
audio. Yeah.
Oh,
All right.
Sounds like you can't hear us. Okay.
We'll just yeah.
Keep it rolling. We do these shows live for anyone that's
So-
listening on the podcast, so it's a little chaotic. But
But either way, we'll give a pitch with Matt. He's an expert on financials. He's been on was on Industry Focus on the financial show for a long time. I used to listen to that all the time. I mean, definitely check out all the stuff that he's been doing. I mean, yeah, really, really knowledgeable about that stuff. Anything else, Ryan? Do we want to pitch for Matt before we get into the show?
no, I've been clamoring to get him on the show, but he's a busy guy. So
I'll pitch his YouTube channel just real quickly. Go it's Matt Frankel CFP YouTube. Just Google that and you'll find it. Great content. One of the things he does really well is he just has really easy to understand conversations about the things about the companies that compelling. If you're somebody that's trying to understand valuation better and thinking about finding value, Matt is going to help you be a better investor.
I switched networks. Can you hear me now?
Okay, we were giving you a good pitch, so
Awesome, and I appreciate that. No, I'm a certified financial planner. I've been writing for the Motley Fool and other websites since, gosh, I'm going to age myself right here, since 2010. After a career as a high school teacher. So I call myself a reformed teacher. But I started doing this kind of on the side while I was still a math teacher. I was a statistics professor at the college level and kind of really discovered that I loved, applying my love of teaching to investing, which has always kind of been a hobby of mine. Ended up becoming a certified financial planner a few years back. I guess, 7 years ago at this point. Time flies, Jason and I both didn't have gray hair, back when we started this game, and now we do. Now we're the old guys in the room. But no, thank you for the nice plug. I do have my own YouTube channel, Matt Frankel CFP. I haven't thought of a cool name. If anyone thinks of a cool brand name for me, please let me know. But I am just
no.
Matt
Keep
Frankel
it
CFP
the
now.
same. Keep the thumbnails the same. Keep the name the same. It is so on brand.
It's working. It's working.
I love it.
Hey, it's been going pretty well. Hopefully people will come out to see us. But no, and Jason's absolutely right. I feel like it's kind of, especially over the past 3 years or so, become kind of a lost art of getting together in person and really picking each other's brain. And there's only so much of that you can do over YouTube. Not to, knock YouTube, but as we saw about 5 minutes ago, it's not a perfect system. A lot gets lost in translation, lost in the shuffle. And, how many times have you gotten off a YouTube call and you thought of a question you wanted to ask the other person just afterwards and things like that? And I'm looking forward to connecting with a lot of people in person. I know Jason and I were both in Omaha for the Berkshire Hathaway meeting and got to see some of our listeners in person there. And it was, in my mind, I don't know about Jason, I was there for 4 days. That was the most valuable experience out of the 4 days.
Yeah, absolutely was. And honestly, I think that kind of planted the seeds for me for doing this. And then as Travis and I talked more about it, this is pretty excited about it.
Yeah. And one more time, it is Money Collaborative. We'll put the website link for anyone in the show notes and in the comment section, just so anyone can get that specific link. Alexandria, Virginia, August 18th. So a little over a month from now. So anyone in that area, I mean, it's a perfect place to go.
Hey,
I'm sure there's a
Matt,
lot of people.
we've got some comments in here too in the
Uh-oh.
YouTube chat that say frankly speaking would be a good
Ooh,
YouTube
that's
name.
good.
Yeah.
I like that.
You
That could
better
be
copyright that now. Like if you're literally not going to the copyright.
Yeah. All right. Well, let's hit some news topics. Ryan, did you want to talk to Activision Blizzard, or I don't know?
Yeah, we can start there. I don't know if you guys have any thoughts on it, but basically it looks like so the appeal from the FTC is not it's not going to work out, I guess.
Was
Courts-
terrible.
yeah, courts basically just gave them the approval to go through with the deal. The only holdup, and I'm not 100% sure on how the how it functions in the UK, but they kind of have to, I guess, evaluate the merger one more time. The CMA, which is the Competition for Markets Authority in the UK, basically protested or appealed against the deal a couple months ago, and now they're kind of looking like they're going to revise that. So the stock's up. Looks like the deal is going to go through. I guess Brett and I have owned this. We have owned Activision in and out at just the worst times throughout its history. But
Yeah.
I guess any
that's for sure.
closing thoughts here? Do you think it makes Microsoft a better business? Do you think it actually changes the video game landscape at all if this closes?
Travis, it seems like you followed this. Do you have any thoughts on it?
Microsoft is going to have to create a streaming business. I mean, that's the point of this, right? That they had to get the content not only from their own studios, but then acquire another major studio like Activision Blizzard to create the Game Pass streaming structure that they're trying to build out to compete with Sony, because they haven't been able to beat Sony in the console wars. I think that is basically over. And at this point, I don't see anything changing that. I mean, we're basically going to have Sony be the high-end console. Then you have Nintendo as kind of the, niche doing Nintendo type things. And then, this is a perfect example of something that happens on the internet called the smiling curve, where you have the big platform companies have a ton of power. The small niche companies have a bunch of opportunity. So this is like the small indie developers who can now pick and choose where they want to put their stuff, but they can have a staff of 5-10 developers and build a game. The ones that are kind of stuck, and this is what I think is most interesting about this deal actually closing, is what happens to EA and Take-Two, because now they're in the middle. They're probably too big to get acquired by Sony or Microsoft, so they're out of the platform side. They're too big to be a niche player. So that's what's going to be interesting to see how it plays out, because I don't think it's certain that Microsoft is going to be successful in this streaming gaming business. They might be. I think it's probably pretty certain that Sony is just going to kind of keep doing what it's doing in dominating the console business. But those companies that are really big names are just kind of stuck in the middle. You look at their financials and they're not great.
Yeah, I think I want to hit on that point as well as the other game publishers that are still out there. I mean, the big ones are EA and Take-Two, but there's Ubisoft, a few others. There's a lot in Japan, I guess, that are of a decent size. There's Capcom, which has been very successful. Their stocks all went up on this deal, or at least on the FTC's decision. And I think investors were projecting that now would be open season for, these companies to get acquired. But I think Travis makes a great point where, okay, Sony's not going to acquire these because they're already even more, they're already doing the stuff that they're telling or trying to argue against for Microsoft. Microsoft's not going to be able to acquire them because they have Activision Blizzard. I mean, who's going to acquire these companies now? Who's the one that makes sense? Is it
Luna?
You mean Amazon?
Amazon's cloud gaming
Oh
thing.
boy.
Yeah.
Oh
We'll
boy.
see.
I mean, I was going to say big tech could make sense, but it seems like they've all been pulling out of, except Microsoft, obviously, pulling out of the gaming market. Is there a realistic acquire for these publishers? Because it seems like investors think with the stocks up like 5% on the news that I don't know. Jason, you have any thoughts? I saw you unmute there.
Yeah, I want to circle back to Microsoft real quick. I think this is important. Historically, Microsoft's been really bad at big acquisitions, but not because Microsoft is bad at big acquisitions, because everybody's big acquisitions. I think that's important. Bad at big acquisitions. They almost never really do what anybody promised that they would do. I think that's important to remember. I have a ton of faith. I don't own Microsoft stock, and I probably never will. It's just not the kind of company that I buy, but I have a ton of faith in Satya Nadella. I will say, if there is a manager of a very large company that could generate some value out of this, it is Nadella. And I think the reason where I think it could struggle, though, is because it doesn't fit inside, like, really the enterprise obviously that's Microsoft's bread and butter. They're trying to build something like that for the consumer side. I just don't know that they're going to be successful at doing it. Right. I think that's the biggest question I've got. When it comes to all of the other ones, it's almost uninteresting to me, because the industry has gotten so mature at this point that, besides an Amazon, who, again, this is an ecosystem company, maybe they go after a Take-Two, even though EA would make more sense because there's a more broad portfolio.
Or Meta can make sense for Oculus, although that's still been stagnating. But yeah,
But let's just burn more money.
Yeah, exactly.
But I think that's kind of the point. I think Amazon has kind of gone through that period. It's like, they're really like Andy, what's the CEO's name? Jassy. He's everything they're doing is focused on generating operating leverage and making money. Right. So I don't see them making a big multi-billion-dollar buy, even though these are across the cycle, right, of their game release dates. These are really profitable businesses. I just don't know that they necessarily create the kind of value that any of these big guys are looking for. And there's just more interesting things to think about for me.
Yeah, I agree. And
go ahead, Ron.
I was going to say, I think some of the brands that some of the big publishers have, like Call of Duty, FIFA, any of the big titles, Grand Theft Auto, those are very durable, and I think they can generate a lot of cash. But given that the space is becoming more competitive, even for AAA games or console games, the building blocks are there, like Travis said, for indie developers to build something that competes with this. I think Fall Guys was an indie developer. Probably, at the end of the day, EA and Take-Two, they're competing for time spent. I don't know if it's the best. I used to think, well, these brands are so durable, just own them and they'll generate more cash. But it's starting to feel less and less predictable, because development talent is so expensive. Like EA, we were talking about this last week, I think, Brett, but EA, their hit title is FIFA, and it's FIFA Ultimate Team. It's diverse, but mostly the FIFA Ultimate Team's their biggest driver. They're
losing the FIFA name, right? So they're gaining a little more control over it, I think, right?
Yeah, and that, I don't think it'll make much of a difference, but that was the biggest driver of their business 4 years ago, and it's grown double digits every single year. And then this year, I think it grew engagement or bookings like 31%, partly because of the World Cup driving engagement in soccer again, or football, wherever you are. And if you would have told me that business is their main cash cow is going to grow double digits every year for the next 5 years, and cash flow is going to be stagnant, it would have, I probably wouldn't have believed you at the time. But I think that kind of is a testament to how competitive these markets are getting, and you got to pay a lot for development talent, and it's hard to build a successful game.
Yeah, this is something that me and Ryan debate a lot. I kind of fall on the other side, where they're low growth and you got to buy it at the right price. But these are really, really, I think, very predictable brands, at least at the top end. I think whatever you call it, FIFA, or what we're calling it now, EA Sports FC, or with Take-Two's businesses like Grand Theft Auto and Red Dead Redemption. I mean, mainly Grand Theft Auto. Nintendo, you have a few in there. Activision Blizzard, Call of Duty is a bit strange because they really, really juice that title. I think they'll still be around and be the dominant brands 10 years from now. But the growth is really the big question, as Jason mentioned there, on the maturity of the console market specifically. We have a comment here that said, on the acquisition front, from Kelly, saying that in college, I had a class that went over exactly how Microsoft overpaid for Skype. So I think that's an example there that acquisition probably made sense at the time, but in these industries, so much is unpredictable. And I'm kind of coming to the conclusion that this is probably a bad deal for Microsoft, because honestly, even though it went through all this FTC stuff about monopolization, that was a lot of baloney. And I don't think this is going to change their position in that industry whatsoever. But before we go to a new topic, Travis, it looks like maybe you have any final thoughts there.
I just wanted to comment on your paying the right price. I started following Activision Blizzard because I think it was trading for about 9 times earnings. This would have been like the early 2010s. That was really compelling to me. Any of these companies at 25, 30, 40 times earnings is an absolute no-go for me. And to your point about, is Microsoft able to generate value? Like, you're right. Like, they are going to have to dominate the streaming gaming space and then also get a whole bunch of, cloud Azure kind of business as a result, and insert AI, whatever. There's a lot of, and then to make this a success.
We don't even know if cloud gaming, how long it's going to take for that to, become a viable consumer product. Let's go to another entertainment company. This was my topic because it came out yesterday, another news report, and it's basically what's up with Disney's executive suite, which is really what's up with Bob Iger. The report, or I guess they did a filing yesterday, that the Disney board decided to keep Bob Iger as the CEO until 2026. I think that's really it. Like, anyone follow this company closely? And I kind of think, does this change anything about Disney? Do you want Bob Iger around? Jason, any thoughts? Or
Yeah, it's this one's so tough, and I think it confounds a lot of people, because if you just start with Disney itself and you think about the intellectual property, and it's a good conversation coming off talking about Activision Blizzard and that stable of IP they have. Disney has the most valuable long tail collection of entertainment intellectual property on earth. It's not even close, right, in terms of what they own. And then you think about,
I'd push back on Disney or with Nintendo. I'd make an argument, but that's something.
Okay, you know what? That's fair. I think that's, but I think you could argue that it is one of the most, right? And it's certainly in that conversation. But then you think about the way that it monetizes them and everything that's going on with linear TV, right? That's a business that's in decline. Sports content is so important. ESPN has been such a cash cow, but again, because of what's happening with linear TV, its ability to monetize that is absolutely getting shredded. Think about movie properties and everything that's happening with the domestic box office is a challenge. China's growing like crazy, and that's an opportunity. But so thinking through like all of these different ways that they monetize that stuff, and I'm sure there's a lot of people, myself included, that are questioning, have we just overvalued what it's really worth? Sure, you can say it's one of the most valuable on earth, but are we hedging too much on that? And then I think about Iger and thinking about what he accomplished and like the lightning in a bottle of his time with Marvel and Pixar. And ESPN was before that, but he was there, but it was before he was the CEO. And all of those roll-ups that happened that generated the 7 or 8 year period of incredible returns, right? And then he walks out the door after the Fox acquisition, which is pretty clearly an overpay, and also acquiring some assets that maybe, same thing, great assets, but maybe we've all overestimated what they're worth. All of that to say, the idea that Iger's magic's going to be back, he's going to fix the operations, he's going to get the company pointed back in the right direction. And if you look at any other 7 year period, hat tip to Tyler Crow, by the way, for sharing this with me. If you look at any other 7 year period in Disney's history as a public company, it's never really been a market beating stock. It had a good 7 year run. That's it.
Interesting. Matt, any thoughts on Disney?
Well, that good 7 year run was mostly under Iger. I'll say that much.
Right. Oh, yeah.
It's historically been a bad move to bet against Disney, and not that it will necessarily outperform the market over long periods of time. It's generally it's a mistake to bet against Disney's ability to monetize its IP. And I love Iger's track record of not necessarily innovation, but of finding the best opportunities at attractive prices. He was the one who presided over the Pixar acquisition. Lucasfilm was an Iger idea. He was the one who started Disney Plus. That was his brainchild. It was poor execution under the subsequent leadership that really derailed it, in my opinion. I think that theme parks are a big underappreciated area. Jason was at Disney World, I know, not that long ago, and he could probably confirm this. Disney could be twice the size. Disney World could be twice the size and still be full.
Yep.
They could charge twice as much and still fill up their existing parks. I don't think they've maxed out the theme parks yet. There are a lot of plans to build on the theme parks in coming years. I think that's a big underappreciated part of the business, regardless of what happens with streaming. And I think they will figure out streaming. So Disney's the one that I wanted to chime in because it's the one I always get pushback on whenever I include it in a YouTube video. Like, you'll see a list of comments that say I agree on everything but Disney. But I think Disney's going to surprise investors over the next decade or so.
So
Can I give you-
go ahead, Travis.
I want to give you some numbers behind this because I think that some of what Jason said is not right. 1980 to 1990, this is not including dividends. Disney stock was up 900%. From 2010 to 2020, it was up 350%. I didn't add in the S&P total return. I assume that beats the market. Did not beat the market in the 90s, and then the 2000s. The 90s, it was up 213%. I didn't pull all the comparisons, but what I think we need to look back on with Disney is understand that this is a very cyclical company. Not only its returns and sort of the hits and misses of its studios, but also just the stock performance. I mean, a lot of Iger's success early in his tenure was just multiple expansion. So a lot of times the narrative of the market becomes then the narrative of the company, whereas it should be the other way around. So I don't think there's any question that Disney studios are in a lull right now for probably a number of reasons. Like, you move into streaming, stuff changes, right? The stuff that worked at the box office doesn't necessarily work on streaming. The things that worked on, Disney Channel doesn't necessarily work. So you've got to kind of reconfigure and relearn what you're doing. And that may take a few years. The Pixar movies, I think, have been that's like a business that needs to just rethink itself after the last few movies. But we go through this over and over again. If you look at the movies before, I think it was like Lion King was the first major one in their comeback in the 90s, right? In the like 5 movies before that, all were just disasters. And then the next 5 movies were icons. So Disney does this. It goes up, it goes down. It goes up, it goes down. And right now, I think I would lean towards Matt's direction, that we're in a down point for a number of different reasons, from the media landscapes to the studios. The parks are the rock solid core of Disney. They will have that forever. Nobody's building parks like that. So I tend to take a long-term view and just say, like, I'm hanging on to it. It's going to be a wild ride, but I think things are a little better than a lot of people think right now.
Has underperformed the S&P 500 for the past 23 years.
You're picking it at a low point.
Yeah, there's also the reports that I don't know if anyone saw the analyst report that predicts someone was going to buy Disney. I think it was Apple. They specifically said. Does anyone think that that's an actual possibility?
No,
I don't think so. Okay. So I think we got a market cap today of $165 billion. Yeah, they have some debt, so you add back on as well. The parks business, as Matt mentioned, I think, a couple of you guys mentioned, is so profitable that a lot of the value in the stock right now is probably just betting on the parks business plus, the other consumer product stuff. And it seems like investors are betting that, or thinking that, the streaming business is really not going to be that good for them. What, Matt, what changes for the streaming business to get it to profitability? How do they get there? What's your thoughts as someone that follows the company closely?
I think they don't need to invest in as much in new content as they have been. First of all, I think that between the existing IP they have, everything that they've made so far, and what they're already making to put out in theaters, that's almost enough to sustain Disney Plus by itself. I think it was they over invested in content. Number one, and number two, now that they're kind of done the ramp up phase. They can scale back. I mean, I hate for people to lose their jobs, but they could scale back how many people it takes to run Disney Plus now that its scale up phase is done. One of my neighbors actually is a Disney Plus engineer. So he tells me that, they have more people than they need. So I think that, it's really an efficiency question and using what they already have to better advantage. They could use the streaming as a complement to the other parts of their business better, like the parks, especially. If you go and you just want to walk through of Disney World before you get there, so you know where everything is. That doesn't exist yet. It could be more of a complement to what Disney already has going on. So I think that the streaming it's early in its evolution.
Yeah, and they could do the bundle stuff that people talked about, giving discounts on cruises and stuff like that. I think one thing that comes to mind is, and maybe anyone can hit this, because me and Ryan talk about this from time to time, and we really don't know what's going to happen. What is the end state of ESPN?
That's a massive question, but I want to cover.
Travis, you and I talked about that, right? As far as
we talked about this.
Sports, it's tough. Like I think the entire economy of sports is going to change over the past decade.
There's a couple of things in sports ties into this, but advertising is something that has effectively not been turned on yet at most of the Disney properties. And this is a company that should be able to monetize just as effectively, if not more effectively, than Netflix. And Netflix said that their advertising service was making so much money that they were just like, we need to increase our prices because this advertising business is so good. You talked about bundling the apps together. They're supposedly going to do that by the end of this year. The sports business is one where the more that I think about this, the more like almost confused I get, because the old world is not going to exist in 20 years. But are we going to go down a path where if I want to watch an NBA game, I have to sign up for the NBA app and then pay whatever? I don't think that makes any sense. So the question is, who rebundles this? And the only company that makes sense is ESPN and Disney. I mean, you could argue like the TNT that's in the Time Warner business, but they don't have the financial wherewithal to be able to do that right now. So I still think all of these things, again, if we talk about like the smiling curve, there ends up being these big companies on one end and these small companies on the other. And Disney in both sports and streaming, I can't see a world where they're not one of the big companies, along with Netflix when it comes to streaming, or theme parks. You talk about like Universal is really their only competitor there. So I think as we mature, Jason is right. We don't know what sports is going to look like, but I think that everybody at Disney, including Bob Iger, knows this has to make financial sense for us. We can't bankrupt ourselves by keeping the NBA. So there's going to be a lot of give and take there, because we learned with this Diamond Sports deal, right? Just because you say you're going to write a big check doesn't mean that you're going to actually fulfill that if your business goes under.
I think that's a really good point, Travis, because this is where the bundle becomes so important, in my opinion, where you could lump in ESPN, Disney Plus, Hulu, because sports rights on their own are not that attractive from the streaming perspective. You look at Fubo, basically, I forget where I read it, but you're essentially just paying upfront this big risk for league rights, and then at the end, if you get any margin out of it, when you renegotiate, they take that margin back, and it's probably more competitive the next time around. Trying to, other companies are going to bid for those same rights. So on its own, it's not that attractive. But if you can use it as sort of a loss leader within a more profitable ecosystem, something like what Disney has, where if Disney's traditional IP is really profitable, you can afford to run some losses through ESPN, but you're going to make it up by adding them to the bundle as a whole. So the only problem now is that they can't really afford to, well, maybe they could, but they can't really afford to use sports as a massive loss leader if Disney Plus is also losing money, and they're pouring money into that. So I don't know. I feel like it's kind of a tough puzzle, or it's a tough investment because I don't know where Disney Plus or Disney ends up in the streaming world. And it seems like that's where everyone's heading. And it just feels like it's more competitive for content, more costly.
Just real quick,
But the parks is wonderful. So I could see the other side of it.
the ecosystem piece, I just a couple words on that, because I think that's the key. Because if you think about linear TV, it's the same thing. It was all about building a large network and keeping people in the ecosystem. If you were Comcast or whoever, right? Exactly the same thing. And sports is big enough in the aggregate that ESPN made sense, because they did have a bunch of NBA games, a bunch of baseball games, college sports, like they had all of that stuff. And it's across enough people that are of the right demographics that you have to do it, right? So it's different now, because that meant that you could kind of hide the money across people that were uninterested too. And that gets harder, right? That's the thing that gets really, really harder for the Amazons of the world to do, is they're building out their ecosystems, because then they start a la carting the sports stuff, as have we seen with like F1 and with soccer, with Apple. You start a la carting it, and all of a sudden the value of an ESPN, where you have all the sports, gets cut down, right? So you don't have that, the sum of the parts is greater, right? Or it's actually greater than the sum of its parts, I guess, is the thing about an ESPN. And what I'm really interested to see is, what are the implications for the bigger sports out there, like baseball, right? Where, these league deals are such a big part of the total revenue pie, that how is it going to affect their ability to maintain the contracts that we've seen for players? You got a guy for $500 million for a 15-year contract. What's that going to look like 9 years from now if the revenue picture has changed? Because baseball isn't now being subsidized by every other sport. That's also being subsidized by people that just want cooking channels, right? So it's definitely in the too hard pile for me. Travis?
I want to add one thing. This is what I think Bob Iger should lead with the negotiations with all of these leagues. You are maximizing your revenue by taking the biggest check. You're maximizing your revenue from older viewers, and you're losing younger viewers.
Baseball, I mean, good example.
Baseball, perfect example. NBA doing the same thing.
Yeah.
Why is F1 popular? It was on Netflix, right? Like hundreds of millions of people have Netflix. What do kids watch? Disney Plus. My daughter knows 2 words when we pull out the iPad because we're going in the car or something. Netflix and Disney. Netflix doesn't seem interested in sports. She knows Disney. If Disney has the attention of the next generation of viewers, that has to be part of your calculus if you're the sports leagues.
Okay, one more question. This is from Kelly again. So thank you, Kelly, for the good comments here. We'll maybe start with Matt and go around with everyone, because I'm really interested to see. This is kind of a speculative question, and I don't think any of us know the exact answer. But here's the question. Do you guys see Disney Plus possibly merging, I think he means kind of Disney as well, with other streaming platforms in a combined effort, like Paramount Plus or the Warner Bros. Discovery stuff? Maybe, Matt, what do you think?
Not really. I could see Disney potentially selling off the streaming business as a separate thing. I think that's more likely than Disney being acquired in its entirety. Like, for example, I could see Apple buying Disney Plus or something like that. Essentially Apple selling that part of the business and licensing their content at the same time. But no, I don't really see them merging with another streaming service. Disney's winning the streaming wars when it comes to subscription momentum and how many people consider it an essential service. I could cancel 5 other streaming services before my kids would let me cancel Disney Plus. It's a lot of American households consider it an essential. And I don't think that the only company that maybe is beating Disney is Netflix. And I don't think that's going to happen. I don't think they're going to merge with, what I would consider one of the smaller and, number 3 or number 4 streaming businesses.
Okay. Travis, any thoughts? Any other thoughts on that?
No, I don't think they're going to merge with anybody or partner with anybody. I think all of those other streaming services, the Peacocks, even Max, are probably just going to go away. They're just going to crush them. And your sign there is that Time Warner Discovery is now selling some of its content to, I believe it was Netflix. They signed a deal a week or two ago, or maybe that was just rumored. But where we're moving is there's going to be a platform companies. So Netflix, I think we put Disney in there. Maybe one other one emerges. Maybe like Apple just spends enough money to be one of these platform companies. And then there's going to be content companies. And that's going to be the two ways to be profitable. You don't want to be stuck in the middle. To just plug my, I did a deep dive on Sony on asymmetric investing. And that was literally part of the thesis was they have already decided we're not building a streaming service. We're not wasting our time with that. We're just going to be a content company. And we're happy to take the biggest check from Netflix or Disney, whoever has the most subscribers and can pay us the most money for what we have. So I think that's the way it's going to move. And I think Disney stays one of the winners in streaming.
Okay, we have another fun topic. I think Matt will enjoy this one. And I think everyone will too, because everyone has housing, I guess, on the mind. I'm going to share something with everyone. I think people have seen something like this from time to time. This is from a tweet from Nick Gurley. And it basically shows, can everyone see this? Yeah. All right. It looks at basically mortgage rates. So the cost of, getting your loan for, I think this could be commercial, but again, I think it's for like apartment buildings or really anyone that's trying to, rent out something as an investment. And then we have the cap rate of those, basically the return or the earnings yield you're getting on, say, what you're buying. And typically, the cost of your debt has to be below the cap rate or else you're not earning anything. But recently, since mortgage rates have spiked, we're seeing this across, a lot of residential, all this sort of stuff. And we can talk about this as a broader housing discussion. It's the mortgage rates are above the cap rate. And from my point of view, as someone that doesn't follow the industry too closely, this seems grossly unsustainable. So maybe, I don't know, Matt, you sound like you want to hop in here. Any thoughts on this dynamic and how it might change?
Yeah, this whole time I've been saying, let's get to real estate. Let's get to real estate. Let's get to real estate. Here we are. So no, that cap rate, I'm pretty sure refers to residential for the most part.
Yeah.
I don't think it's sustainable. You're starting to see cap rates come up, especially in other types of commercial properties. And as the key is, when is the debt coming due? Commercial properties are financed differently than residential in that companies, if you buy an office building, for example, you'll get a loan that's a 10-year interest-only loan that at the end of the 10-year term, you intend to refinance. So you're seeing a lot of this debt starting to come due, and people are going to have problems because one big thing to know, you had the cap rate right there. Cap rate and property value have an inverse relationship. So as cap rates start to come up, which they are in pretty much everything but residential real estate, property values are going down, and it's going to be tougher and tougher for companies to refinance their debt. No one's going to refinance $100 million loan on an office building that's only worth $60 million. So you're going to have a lot of kind of strategic defaults like you saw in the residential market in 2008 or so. And that's where the real crisis is right now, that cap rates are coming up, which is good if you're an investor, if you have money to invest, because you're right. Your cap rate has to be less than your cost of financing for it to make sense, or it has to be greater than the cost of financing for it to make sense. If I can borrow money at 7% and get a 5% yield by investing it, it doesn't make sense to borrow money to invest. So you're seeing a lot of pain coming in these markets, but a lot of opportunity as well for the companies that, for example, can self-finance. A lot of my favorite real estate investment trusts right now are the ones that, have $1 billion on their balance sheet and can finance their own development projects. That's a big competitive advantage in this market. When money's free, no, it doesn't matter who has a well-capitalized balance sheet, because you can borrow money for next to nothing and build a property and make money on it, et cetera. But if money's expensive like it is now, the companies that have that financial flexibility and have very low leverage, have room to absorb the higher cap rates on their balance sheet without having to, go bankrupt or give some of their properties back to the bank it's a huge competitive advantage. So there's a lot of pain and a lot of opportunity at the same time.
All right, Jason, anything to add?
Yeah. So first thing, commercial real estate, residential real estate, these are all gigantic catchphrases to talk about really a lot of different things. I think that's super duper important. And you kind of hit it off on the head there. That chart was maybe talking about residential, but the situation with residential, there's no inventory of single family, right? We're seeing record levels of building from single family and multifamily construction. Like we're basically, I think the records were in October, November of 2022. The current build levels are only behind those record levels because there's no inventory being listed for sale of existing family homes. We can argue all day about, well, maybe there's a bunch of property that's eventually going to go out, but a lot of it is like just where stuff is. You know, the Sun Belt's really hot. There's not enough inventory in the Sun Belt, right? And there might be inventory in other places of potential, but it's not there. Where the pain is going to be happening is largely going to be in commercial office, right? And we've seen public REITs, the prices have come down a lot already. So there are opportunities for investors like Matt was talking about. Where the pain is happening is mostly going to be in privately owned real estate. Okay. Public REITs front run that. We've known for a year there was going to be pain coming because the smart money already sold out of the REITs where there was going to be trouble, but those private REITs are not liquid, right? So they're the ones that are going to struggle. And thinking about where to avoid the risk, there's a lot of regional and smaller banks that own a lot of that commercial office space debt. You know, if there's, it's in the little town in the mid-market that the local bank financed the commercial office building. It's not B of A or one of these other big ones. So I think that's a really important way to think about it. And then there's some other really good commercial real estate, like industrial real estate. We talk about Amazon, right? Think about everything that they're doing with e-commerce. There's massive demand on, onshoring of manufacturing and assembly, right? So all of those things. So it's really easy to put real estate in this big bucket, and it's not. It's a bunch of little buckets. Actually, it's a bunch of big buckets. Ryan, you had a question?
Yeah, I've heard people mention that inventory is really low and homes available for sale or for single family homes is kind of towards a record low. But part of me thinks, okay, maybe there's a shortage, but the other part of me thinks, well, maybe it's the fact that no one wants to sell their home because they were getting quotes at higher prices a year ago, or their neighbor sold their home a year ago for 20% more than their house would be worth. And they don't want to take the pride knock, or maybe they don't want to have to purchase a new home on the current mortgage. So I guess, what's like, I don't know, do you think that new supply that's coming online is going to be able to kind of buoy prices, or do you think that prices have to come down if rates are staying this high?
We've already seen the bottom, I think, with new construction. It's already started to pretty much stabilize and recover. So and one of the reasons that's happened is it's not perfect. And again, we're talking on a national basis. It's different from market to market. And part of that is because when we saw builders start to back off a ton, when interest rates started to shoot up, they pulled way back because they were expecting an utter collapse. There was a pause, and then demand has started to recover. So they're like, okay, well, we got to go back out there because demand is still there. The industry's cyclical. Who knows exactly what's going to happen? And Ryan, I think part of the answer to your question is, sure, there's some of that. There's some of it that are potential sellers that have flexibility that are like, well, let me hold for a better price. But eventually life has to go on, right? So I think we're going to see life go on for a lot of people, and the time to sell is going to be when you have to sell. But I think the biggest thing that doesn't get enough attention is the on the residential side, new household formations, right? There was a lot of household formation that there wasn't enough inventory to meet it over the past 12 or 13 years. You know, we just didn't see a lot of single family home construction from 2010 through 2018. Right. And 2017, 2018, they started to ramp back up. So there's a massive amount of underbuilding to fill just that cohort of household formation that's happening right now. But again, it's a really local thing. So there's no easy, simple answer.
I have an unpopular opinion here, but I think that everything that you guys are saying is right. And the answer is that we're going to have to inflate our way out of this. And What I mean by that is valuations spiked from 2019 to 2022. Maybe you refinanced like we did in 2020, and now I have a 2.8% interest rate or whatever it is. And so I have no real incentive to sell. So you're holding on to that asset a little bit longer because you can't just replace it with.
It would literally cost you money to buy a house that costs the same amount today.
Exactly. And so the answer is that yes, in my mind, and even in the market's mind, my home is overvalued today. We could sell it for probably an abnormally high amount of money if we were just sort of to reset all the value of housing. But over time, that will normalize. And this happened during the great financial crisis. I mean, the only thing that really got hammered was condos, because there was a ton of people speculating on a bunch of those things. I know that happened here in the Twin Cities, but housing just kind of it like did this wave thing, and then it just started to rise again because interest rates were low, the economy went on, but it just took a long time for valuations to kind of normalize from abnormally high to like, okay, this is fine. And I think that's where we're going to be over the next decade. 3% inflation means that the value of your dollar, your home, if it just follows inflation, is going to go up about 35% over the next decade. Well, if your value is 35% overvalued now, maybe your value of your home is just flat for the next 10 years. That's what I mean by inflating our way out of this.
I've got a question, and I think that Travis bring up an interesting point there, but and I think part of it is maybe that Brett and I are just non-homeowner haters, and so we're just like waiting, and we're like, oh yeah, prices are definitely going to come down. But I guess I have a question on the commercial side of things. I've seen this floated around a lot, and it seems like it's mostly speculation that occupancy rates are down, refinances are coming, as Matt just mentioned. I guess who's the loser in this scenario, aside from the people that borrowed a bunch of money for these commercial properties? Are the banks in trouble? Do the banks sell these through to package them in mortgage-backed securities? Like, if there's some big commercial real estate crisis, who are the big losers?
You're absolutely right. It's the banks, specifically the regional banks that have a lot of commercial real estate debt.
Yep.
The big banks generally don't have a lot of exposure to commercial real estate, and if they do, it's a manageable amount where they're just given their capital requirements and things like that. But there's that old saying: if you owe the bank $100, you have a problem. If you owe your bank $1 billion, they have a problem.
They have a problem. Yeah.
And that's really what's going on here. One kind of interesting thing on offices, especially because that's really where the problem is. I interviewed Willie Walker from Walker and Dunlop the other day, and it's his opinion that the way out of this is on a massive scale office to residential conversions.
Yeah.
It solves the problem of rising home prices to some degree because it adds more supply to the market. It solves the problem that we have millions of square feet of excess office space in our urban areas. Now, it's not practical to convert every single office building to a residential property. That's just not possible in a lot of cases. You need a lot of plumbing infrastructure that isn't there in some of these high rises, for example. But it's a really interesting possibility. And the more I think about it, the more I think he's right, that it's going to kind of force the hands of these real estate companies, especially when they, these properties fall into foreclosure and have to get sold to developers for pennies on the dollar. Then it might actually make economic sense to do it, because right now it doesn't. And that's the big holdup to office to residential conversions, is that it's not financially practical in a lot of cases.
Willie Walker's dog in this fight, by the way, I think is important. They mainly do multifamily housing finance, right? So he has a very vested interest in that. I want to share it just real quickly. This is really important. It goes back to the past topic. I think it's really important to hammer home the difference in housing and the financial crisis and the housing bubble there and where we are now. So this is just housing completions. Okay. This is new construction completions. This is what happened leading up to the housing crisis before the global financial crisis. This was the extreme overbuilding. Okay. This is where we are now. We're back to 2002 levels of construction. This is how much we underbuilt. Okay. I really want to stress that because this is a very different environment when it comes to single family residential properties than we've ever been in. And I think it's also important to point out that on the commercial side, we don't have that same dynamic, right? It's not that leveraged like we saw with single family housing that it can cause that sort of damage to the economy, right? I think it's going to be far more limited.
But let me for the listeners, let me describe the chart since a lot of people didn't see that or won't. They won't.
Oh
see
yeah,
that.
the charts work really well for podcasts. I'm really
So before the GFC, there was like 2 million homes, or we kind of hit like a 2 million home rate per year.
1.5, right?
Or 1.5, or no, it was
no.
Yeah,
sorry, it was 2
million.
million. Yep. Okay.
Then after the GFC, or when the housing bubble burst, we collapsed down to 500,000, and now we're climbed back up to 1.5 million. So we're not nearly where we were, but we still are recovering from a long period of probably 7 to 8 years.
7 years of extreme underbuilding. And the first few years of that, more houses were actually being, if you took in the houses that were actually being leveled, the net inventory in the US went down for 2 years. Yeah, it was extreme.
And on the office to residential, I mean, that's such a interesting topic because we're from Seattle and it seems like that's the only way the downtown gets saved.
Yeah.
Right.
So I want to respond to that because I somehow I ended up in real estate Twitter. I follow some people who are local here who are developers, and so I get a lot of like smart real estate people see what they're thinking. And this has been a topic, and to a person, and this is, by the way, this is in their financial interest to say like, yes, great, I will be that developer. They're all just like, it doesn't work. It doesn't work. Like there may be a project here or a project there. Yeah. But like you talk about like they need to make some plumbing changes. You're talking about instead of one big pipe running up to, next to the elevator, now we have to have 50 different pipes because every single, unit has to have water and, their own multiple toilets. And the cost to reconfigure a building from commercial to residential is so astronomical that it doesn't make sense just generally, especially when interest rates are what they are right now. So I want to push back on that. It's a great thought. It's a great idea. Reality is different.
They can just sleep in the cubicles, Travis. It's fine.
Yeah. My thought is that it might be cheaper than having your office sit empty forever though. Because I think there might be no other option than to maybe, if like Matt mentioned, they have to go through bankruptcies basically, and then they come out the other side. There's just this space. If it's empty, isn't that just worse, or is it more expensive to go through the rebuild? Maybe. I don't know if anyone has any thoughts on that. This is just from a pure outsider perspective.
Sounds bullish for the Culligan man to me. That's
the Culligan man always wins.
There you go.
Okay, we have 2 minutes before we shut this thing off. So I guess earnings season's right around the corner. I've got a couple companies that I want to see
just
report.
Today. Yeah, Pepsi kicked it off today. What
about you guys? Is there anything that you're watching closely? Is there anything where you feel like this earnings season's a really important one for any companies you own?
Regional banks.
Yeah. Okay. Go back.
Yeah.
Go back.
Yep.
Regional banks. I agree. Yeah.
You had a good one too there, but two in particular I'm watching are Truist and US Bank.
Yep.
Just because they are the ones that shouldn't have been affected by anything, but their stock price makes them look like they were.
Yeah.
Just because of how big they are. So those are two in particular I'm really watching.
Yeah. I'll say Lemonade again, just real quick, seeing them continue to bring that loss ratio down and actually prove that they can originate insurance at profitable levels. They do everything else great. If they can do that great, they have like $600 million in in-force premiums. They are a tiny, tiny insurer in $1 trillion industry. So if they can figure that out, this is an important quarter to show that.
All right, Travis.
I'm interested in looking at the entire auto industry's dynamics. I think the transition to electric vehicles is happening, is real. But if demand for electric vehicles is growing 50% a year, but production is growing 100 or 150% a year, that doesn't make for good economics. And
nice little capital cycle. Yeah.
that's I think what we're seeing is that we may actually see really good earnings from the old legacy companies, the GMs, the Fords, and we may see terrible numbers from the Teslas and the Rivians and the stocks that have actually gone up a lot recently. So I'm really interested to see what that dynamic is, because I'm trying to kind of suss out exactly what's going on. Companies aren't reporting their backlog anymore. That just magically disappeared a couple of quarters ago as Tesla started, cutting their prices by $10,000 a vehicle. So what is the actual financial metrics that we're going to have going forward? Because all these companies that thought they were going to be 25% gross margin, it's not going to happen.
All right, Ryan, what's yours?
I guess bridging the gap between Travis and Matt there. I'm eager to see Ally Financials. I mean, they're one of the biggest auto lenders, and it's such kind of a precarious spot where their assets are at now, because it seems like it's priced as though people think there's going to be a big kind of implosion in the auto market. So especially in the used car market. So if there isn't, or if we see some sort of stabilization in prices there, it feels like Ally's in a good position, but we'll see.
Yep. And I'll say I'm looking forward to Match Group. So many variables affecting them right now. And, foreign exchange, the rebuild of Tinder, all this stuff, the new marketing campaign, the quote unquote revamp. They've given all these great data points. We'll see, whether it actually improves their income statement.
For 8 quarters in a row, we've been saying, oh, if we just exclude foreign exchange, this company's doing just fine.
Oh, they're gonna, I mean, hey, it's actually a benefit now. So we'll see. But we're 1 minute long. Thank you to the 3 of you for joining us. Remember, it's in Alexandria, Virginia, August 18th, and it's called, what is it called,
Money
guys?
Collaborative. Go to moneycollaborative.com.
Yep.
Sign up. Give us
The
your
link
$100. Show up.
We'll put the link. We'll put the link in the show notes. Let me put the disclosure in. Thank you all for everyone for listening. We are not financial advisors, or Ryan and I are not financial advisors, and anything we say on the show is not formal advice or recommendation. We are general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you, everyone, for tuning in. These go live on Thursdays, right around noon or 12:30 Eastern time.